ask ourselves whether the taxpayer should carry on funding this. Many people are saying we should not be doing it.
Right, moving away from SAA, coming back down to ground, property investment around the world is changing, and the global investment house, Schroders, says that the rise of technology giants has affected how people choose where to live and where to invest in property. Schroders is behind the Global Cities Index, which measures what the company deems to be the most economically vibrant cities in the world, and therefore good prospects for investors. It offers funds and a listed property company to South Africans. We're joined now by the co-head of Global Real Estate Securities at Schroders, Tom Walker, live from our studio in Cape Town. Mr. Walker, thank you for being with us. Tell us how technology companies are affecting real estate.
Yeah, I think there's a number of things going on here. I mean, I think maybe just before we get to kind of technology and how that is disrupting the real estate market, I think really the most defining trend that we see disrupting the real estate market at the moment is actually urbanization. This move to these very strong cities around the world that provide jobs for people, which is where they're centers of innovation. That's probably the most defining trend, I think, within the real estate market. And then that really creating unequal cities around the world, or unequal playing fields. It's very hard for, say, for instance, any city in South Africa to compete with Johannesburg or Cape Town in terms of the jobs being created and the innovation. And I think when you look at technology, technology is then changing the types of real estate that is really important today. And I think the classic example is what we're seeing in the retail world today, in shopping centers in particular. Amazon and online retail sales is really destroying the value of many shopping centers around the world as we as individuals spend more and more online, and there is less of a need to visit these physical shopping centers.
Because we can spend so much time online, I mean, urbanization is strong, but isn't that giving people freedom to live outside of cities, to commute less often, or is it still being just blown away by the pull of cities themselves?
Yeah, it's a very interesting question, that, and a lot of we get that question a lot, but I think that really, when you think about cities today, we really operate today in sort of what we would refer to as knowledge-based capitalism. It's this idea of exchanging information and ideas. So the concept of starting up a business where you never meet people is really not possible. Humans by their nature are social creatures. We need to exchange ideas and innovation. And I think perhaps one of the classic examples where we see this is maybe in a city like Boston in the States, which is where you have 3 of the world's top 10 universities, MIT, Harvard, and Tufts University, and it is the biotech capital of the world. The research into new drugs to cure incurable diseases is absolutely incredible, and there is this fusion between the academics and then the private sector. Every big pharmaceutical company will have an office in Boston so that they can try and get access to the brightest minds. And so in that industry, like many others, they talk about collision and collusion. Collision of the academics and the private workforce colliding together to discuss the ideas, and then collusion, working out how they're going to improve things. So I think that's for us why cities will continue to be very relevant to economies today.
And you talk about tech firms setting up, they want to be in the cities, attractive to professionals. It's no longer factories on the outskirts of cities. We don't have those huge tech firms, for example. How attractive, I'd like to know, moving away from that, are South African cities to global investors right now?
Yeah, it's again another, as you would imagine, a very popular question in this part of the world. And I was in Johannesburg earlier. So we have our Global Cities Index, as you previously referenced. And when we look at the 2 strongest cities in South Africa, it's firstly Johannesburg and then secondly Cape Town. But the reality is, and I don't need to be rude here, is that when we look at these cities, we are comparing them to Sydney, to Tokyo, to Manhattan, to San Francisco. And really the job creation, the wealth creation, the transport infrastructure in these cities is so exceptional that it means that Johannesburg and Cape Town don't look as attractive to us today from a capital allocation point of view. But I think that's perhaps one of the interesting areas for domestic investors to consider. It is about diversifying your real estate exposure away from your domestic country. And I know particularly this year it's been quite a challenging year for some of the domestically orientated REITs. And really, some of these trends that have occurred this year from the domestic REITs have been very hard to forecast. And so that just brings me back to the benefits of diversification and spreading some of your real estate investment, some domestically, and then some into these very strong fortress cities that create the jobs which are so important for all of us.
And you can go into property funds in those cities, in those countries. What are the hallmarks of a city to invest in? Because you have this Global Cities Index, the players are there, the usual ones, London, New York. But what puts Los Angeles at the top of that list?
Yeah, that's right. I mean, we look at 5 factors. We look at the economic growth in the city, GDP. We look at retail sales, population growth, university rankings, and then median household disposable income. All of those factors are really linked to rental growth, which is really what we as real estate investors are looking for. But I think one of the secret ingredients of any city is the universities, because that brings through the brightest, most talented graduates through into that city, which will then enable the businesses located in that city to have new ideas, to innovate and become more profitable. So we see a really strong link between all of those 5 factors as being vital for what you should look for when considering any city. But I think also another vital component is really where it's quite hard to build. We don't really like a city that has lots of sprawl, no defined area. So you can think of Dubai. Johannesburg is another good example of where it's quite hard to distinguish where the city begins and ends. So we want to try and invest in a city where there is some tension, there is some scarcity. So obviously if you have more people moving to a city, more businesses expanding, and there is not an infinite supply of real estate, then rents can grow. And that's obviously what we're looking for as real estate investors, pricing power and rental growth through all types of economic situations.
And London has lots of scarcity. Final question, how difficult would it be for South Africans watching, thinking, maybe I'd like to invest in property overseas? How hard is it to do that? And how do you advise people in terms of physical investments compared to just owning a good property stock somewhere?
Yeah, I think the main issue with physical investment, i.e. buying and selling the flat or the office building or the shopping centre in other countries, is the tax that you are going to be paying, the high levels of stamp duty, the legal fees, the fees to operate that asset. It makes it very hard, going back to my earlier point about the need for diversification away from your domestic market. If you were to try and build and buy a property in all these cities around the world, you would find it quite inefficient. So therefore, what we find is far more efficient is that immediate diversification you can get from investing in a listed real estate company where you're not paying those underlying high charges that will, really deteriorate the investment returns that you might get. And I think perhaps a more important point is actually the exposure to the type of assets you can get through listed companies. I mean, if you think about one of London's iconic shopping centres, Westfield Stratford or Westfield London, over 40 million people visit those shopping centres each year. It's a staggering number. They are going to continue to be very relevant assets as the online retail sales market grows. But yet, if you own shares in the company that owns those assets, that's pretty unique exposure, which is not going to be built again. Another great example is the Empire State Building. We own shares in the Empire State REIT, again, an iconic asset in Manhattan, which is not going to be built again. So we really like that kind of scarcity in a city, as well as these unique assets around the world that we can own.
All right, interesting. Looking at South African cities in relation to cities around the world. Thank you very much, Tom Walker from Schroders.